Kenneth Andrade joins us. Let's take our conversation forward. Kenneth, good morning. Thank you for joining us. Kenneth, a lot has changed, and a lot has changed suddenly when it comes to how China is looking at changing their economic policy. How should one read into that? I'm starting with not India but with China, because on a daily basis you're getting news about this is a change that is going around, this is where China is clamping down. How should one read into the sudden policy change by the Chinese government?
Well, Nico Jabin, I heard you sometime earlier during the just before this conversation, and you almost got a spot on this, talking about how supply side disruptions are leading to inflation, and inflation is leading to higher commodity prices, and higher commodity prices are leading to higher profitability by companies. So I'm not going to repeat any of that because to a very large extent, that's the chain of events that's happening around there. But I think we need to watch a little bit carefully because if inflation continues to be at the level that it is, it will definitely lead to demand destruction. So, so, so that's probably the only caveat I put together in this entire argument. It could be a very good year for profitability. It could be a very good year to start the capex cycle, not just in India but across the world, as supply chains get relocated to their individual countries. And we just have to look towards the West as to if all the capital that's gotten printed, if it goes back into the real economy. I think we will be back to somewhere where a lot of the should I say old economy stocks or the commodity businesses and the capex cycle should do extremely well. So so the contagion that's happening right now, or should I say so what's happening in the Chinese environment is they're the world's largest manufacturer, and they're stepping back. The rest of the world has to pick up a mandate and move forward, and that's going to be reasonably material intensive, or should I say commodity intensive, and I think that should play out over the next decade, or probably a little more than that.
Kenneth, everybody in the market is not questioning what is happening in Indian economy. The conviction levels about where earnings are headed, where economy is headed, how things are normalizing, I think is there. By and large, 8 out of 10 market men and and market participants are convinced that the economy has stabilized and better days are coming. The question is that are markets pricing in a FY23 and a 24 earnings? How would you argue on that?
So split this up. Look at the Indian economy and look at corporate India. Right, the Indian economy is stabilizing. That's right. But there are a lot of things you need to iron out there. First of all, I don't think per capita income is going to be climbing the way it's done in the last decade. That's definitely not going to happen. We got to get employment generation back, and employment generation across the country rather than in specific industries, and that's going to take its time. So just delineate the Indian economy from corporate India and look at where corporate India's profitability is coming from. So all your indicators that are there is essentially coming from the fact that the international markets for everything is doing extremely well. And you speak to any corporate that's coming on board, and everyone talks about export volumes actually picking up, or uh, international demand for Indian products are reasonably high. So 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 my sense is we will the macros in India will look good. It'll look good because of a particular sector or two or segment or two, and it's largely linked to the global trade rather than looking at it from a very India specific opportunity at this point in time. Though there's a medium-term trade that's also there, and that happens to be somewhere along the lines of the PLI scheme. And if you look at the PLI scheme that's there and the sectors that it's addressing, and and you just try and compute the non-oil imports in India and substitute that, that could be a great GDP multiplier. So things seem to be falling into place, and and from an earnings standpoint, um, we might be discounting 2023 earnings. 2024 is a little too far away to see.
So, Kenneth, at this juncture, given that you manage public money, are you still accepting fresh inflows? Are you still finding value in the stocks where you were invested in? The reason why I'm asking you this question is that sometimes at the peak of the cycle, money managers have argued that, look, we don't find value in the market and we will not accept fresh flows. Are we reaching that level?
Uh, so Nikunj, I've been doing this for the last 15 years in the public markets, or maybe the last 18 years in the public markets. So money comes in at the top and money comes in at the bottom. At the end of the cycle, if you give it 5 years or more, you very rarely are not in the money, right? Your return profiles actually differentiate, are different, but over a fair period of time, you do make money. So I've probably come off to one of the worst cycles, and all the last 5 years numbers have been normalized to a CAGR of about 19.5 to 20%, and that's what a large part of the market is already given. Now the different thing is, are we willing to take money at this point in time? Uh, you will have to have the patience to go through the cycle, right? Don't expect a linear trend in the environment. And all I can say is that you have to be tread a little carefully now than you've done it in the last 18 months, because this is not March of 2020 or somewhere. We are not anywhere close to being in value territory. Of course, there are opportunities and there's a cyclical recovery that is there, and that will explain the growth in the entire environment. So yes, happy to take money, but what's happened in the last 18 months or probably 2 years, don't expect the same kind of returns getting generated all over again.
Kenneth, good morning. You had very recently said that this decade is going to mirror the 1990s. Why did you say that, and is it how it's panning out? Are you expecting the value and the growth to really come from exports? You were just alluding to that, and therefore, is that what you're betting on?
Well, so from a macro standpoint, if you look at it, or from a much larger standpoint, if you look at it, India is about 3% of the world GDP, right? And if you just limit yourself to the Indian economy, there's very limited growth that you can get till the economy actually picks up. And look at the companies that India has created when it stepped out, or look at the entrepreneurship that India has created when it stepped out. Take the IT sector, take pharmaceuticals, let's look at what's happening with chemicals. And obviously, in some of the commodity businesses, we do have the entire value chain present with us and very cost competitive. Now, if you put all of this together, I think the profitability of some of these companies, some of these industries, could be significantly larger than what they could be if they just address the domestic market. And we are finding our space out there. So exports and addressing the global market is like trying to get your market share of 100% of the world GDP. And today it's much easier now that the world's largest manufacturer has stepped back. And now there's pricing power also. So both things are working together. You got the price and you got the volumes. And yes, I think that's probably one of the best advantages any Indian business or entrepreneur has today.
So is that where the opportunities lie? Maybe look at the mid caps or even the large caps, which are export oriented, serving the markets, and therefore they will stand to gain disproportionately, and that's where the opportunities will be for investors?
That's exactly where it is. I mean, you're getting the volumes, and volumes are driven by the Indian environment as well as international demand. And pricing it's international led. So using inflation in manufacturing, using inflation in commodities, and of course in a number of agricultural products. Using, I mean, I don't think you've seen enough inflation yet. So that's also coming through, and all of that is reasonably good for corporate profitability. We'll have to wait and see if demand gets destroyed. And my sense is that if this continues for a little too long, demand will demand will have its problems. So in a sense, we cost competitive, which is what we saw when we were emerging out of the 90s. We've got the market opportunity, and today we've got scale, and we've been able to address a number of larger industries than just one or two. Uh, and and I get the sense that some of the Indian companies that are already out there, or some of the Indian businesses that are already out there, could be quite large as we exit the next 5 or 6 years.
Kenneth, but from these elevated levels, where is it that there's money to be made? Is it in the entire reopened trade? I mean, everything from aviation to hospitality to multiplexes to even a VIP has been holding up off late. Is it the autos, which in the near term have underperformed because of various many reasons, largely because of the chip shortage? They seem to be making a comeback. Or would you say that just stick with the ones which have given you the good returns and just ride the tide?
From a strategy standpoint, we basically think that the cycle has changed, and that's and what we're seeing right now is a completely new set of business companies that will do very well. Okay, what happened in the last decade? You had the leveraging of the consumer and the consumer economy that led to reasonable amount of growth, and market went to its all-time high somewhere in 2019 and 2020. That cycle is essentially changed. We've got a whole load of manufacturing businesses and backed up with a certain amount of utilities that are there. Demand for power will move up if India shifts its entire economy to a manufacturing zone, because manufacturing is energy intensive. That's one leg of what we're doing. The reopening trade, or when you talk about consumer demand that is there, it's going to be in very specific geographies. It's going to be all about urban India. It's not going to be across India. It's not going to be anywhere close to the rural parts of the environment. Now, what's happening in rural India? It's very specific to a few businesses that will generate enormous amount of cash flow over the next 2 years. A lot of these companies are already debt free, right? And when they generate this kind of capital, so you take the largest aviation business, you take some of the QSRs that are there. When you or some of the even multiplexes that are there. When you generate these kind of cash flows, with in the next 2 years, just because your utilization levels will be far higher than what you've seen historically, you will be able to fund 2 years of growth without recourse to external capital, right? So the reopening trade is how much cash flow can a company generate over the next year, 2 years, and how productively do you put that cash flow to work to expand your network? Okay, that creates a kind of a monopolistic situation for your franchise. So it's all about how well you position today if you survive the downturn, how you'll create that cash flow in the next 2 years, and how well you'll deploy that cash flow to create a significantly larger franchise than you exited this pandemic. Okay, so that's how we look at it from a reopening trade. So there's an opportunity out there. It's very profitable, and it's very scalable. And some part of the country is going to be very consumer centric, which is we tend to believe it's going to be very urbanized rather than a pan India consumer economy.
So, in this reallocation, Kenneth, do you think there is merit in being market cap sensitives? I mean, do you need to make that juggle or shift from large to mid to small caps, or vice versa, or whichever may be the combo? Or do you think the better strategy is to be market cap agnostic, just look at the individual companies and what growth and profits they're going to generate in the future?
I tend to be very market cap agnostic, but that's a preference that I've chosen to be. And if you're very good at moving from large caps to mid caps to small caps and back again, I think that's a different skill set that's a very different skill set and a very different allocation to look at. So we are very agnostic to market cap, and today we find opportunities right through the right through the market cap, uh, through different levels of market capitalization. That is there.
Kenneth, why are banks underperforming? If we are at such a strong cusp of an economic recovery, I understand that corporates, because of uptick in commodity cycle, they are generating serious cash flow. But that will only take care of 6 months, 8 months or 12 months. Ultimately, you would have to do fat capex. But markets are telling you a different story. Banks, which is a proxy, and corporate banks, which are a proxy to economic growth, they are not massive outperformers.
So, so in the near term, there'll be no demand for credit from corporate sector at least. And just to address the just the just to address the fat capex cycle that some of the commodity companies will go through. So take any steel business. To put up 5 million tons, you need 25,000 crores. Uh, I mean, India's top three companies, or probably four companies, will make that 25,000 crores of cash flow in 1 year. Okay, so they are definitely out of the borrowing cycle for now. If at all, corporate India's debt equity will hit its all-time low this year, exit 2022. We are all we are almost at the bottom end of the of the leveraging cycle for corporate India in exit of 2021 numbers. And this is on the NSE 500 companies that are there. And we will exit 2022 with an all-time low in debt equity. So corporate borrowing is not coming back for sure. So from a bank perspective, I think they did fairly well over the last decade and a half, and that also private sector banks. Uh, so give them some time. There will be a couple of banks that will do well, but from an industry perspective, from an entire industry perspective, I think the best is behind us.